Swayam Prabha. Digital India. Educated India.
We shall pursue the sources of monetary base. Why? Because when monetary base changes, money supply changes. And when money supply changes, you know the LM curve shifts. And when LM curve shifts, there are significant consequences for the economy. Rate of interest may change, output may change, prices may change, employment may change, various kinds of changes you can expect. That's why you have monetary policy, which is trying to control unexpected and undesired changes in money supply or any other undesired occurrences in the economy. Via LM curve, monetary policy is nothing but via LM curve, we are trying to control the economy. So, sources of monetary base is very important. What are the sources from where monetary base is created and therefore is liable to change? Like a river is the source of a river is a glacier. So, anything happens with the glacier will affect the river. So, it is very important to know the sources. So, I would pursue that discussion on sources of monetary base, which I started yesterday. So, what did I write? Sources of M naught. So, I said from the definition that you had, recall that the uses of M naught, how M naught is being used in economy, was that M naught has a currency with the public, you can call that C, plus some bundle of reserves, which consist of, I said, let us say 2 items, ignore other deposits. So, it has the cash with banks plus the required reserves with the central bank. And other deposits RBI, I said ignore that, the other deposits are very insignificant, statistically, numerically very insignificant number, ignore that. So, this is the definition we had earlier, currency with the public plus cash with banks, which I called currency in circulation, plus bankers deposit with RBI, plus other deposits, I am saying drop other deposits. Now, the question is what we are going to look at the sources is how is this C and R getting affected in the economy. Okay. Now, if you look at the balance sheet of RBI, which we do not have here, where all items are recorded like balance of payments account, all items are recorded when you exchange goods for other countries and there is a money flow, capital flow between countries, all transactions are recorded in the balance of payments account. If you look at the balance sheet of RBI, you will notice certain items, which we would identify here as the sources of monetary base. The sources of monetary base, if you look at the balance sheet of RBI, you will see there are, according to my notes, 5 sources, mainly 5 items. So, you have an item like government's currency liability to the public. What does it mean? Government's currency liability to the public. Two, why is government currency liability to the public is there? In India, the currency system we have is a very funny one. The notes, if you remember, I was reading out from the notes, the currency, clearly the RBI governor's signature is there and he is saying something, and also it is backed by the central bank, backed by the central government. If you take a coin, you will not see anything like that. There is no RBI signature. One side it has the Ashok Stamba and written Bharat in Hindi and India and a date. Niche mein calendar year 2008-2009 when it was manufactured in a mint. They are manufactured in a mint. Government currency or currency is produced in a factory called Mint. And on the other hand, it's written what this value is of this coin is written 1 rupee. The value is written 1 rupee. And there is nothing. Now, therefore, we have a system where partly it is the RBI guaranteeing it, which are notes, and the coins nobody is guaranteeing it. Well, that it is written Bharat and Ashok Stamba, it implies the central government is guaranteeing it. Central government, though nobody's signature is there. Therefore, the currency liability to the public, liability is a responsibility to the public, meaning what? Why is it liable? If I hold a 2 rupee coin, why government is liable to me? What's the government's liability? Government's liability is this should be an authentic currency, and if I use it in an exchange, it should be acceptable. That the government should ensure. Like a seller, which doesn't happen in India, seller of goods is liable towards the quality of the good when he has sold it to you. But India doesn't happen. Seller, as soon as it is sold, takes his hands off and say, what can I do if there is a defect? Often it refuses to replace it. But that's not the case. That shouldn't be the case. So, the liability word here basically means is the responsibility, you can say, of the government to ensure that this coin, when it is circulating in the Indian economy, can be used as for goods worth 2 rupees. Yeah? Do you understand what I am saying? Achha. Now, so what is government's currency liability? These are the coins. Coins are guaranteed only by the government, central government. So, all you are talking about here, the coins. The notes, you clearly see it is written RBI, governor of RBI signature, and etc. So, the liability of the notes is that of the central bank, RBI in India. That may not be the case in other countries. It's in India I am talking about. All right. So, government's currency liability to the public will be the coins, and the coins is a very small percentage, 1.2, 1.3%, something like that of the total currency in circulation. All right. Next, net RBI credit to the central and state governments. Net RBI credit to the central and state governments. Why is it net RBI credit to the central and state governments? Credit is what? Credit is like loan. What is RBI's loan to government? Well, government is often in a deficit situation. You take a simple case where governments are not functioning poorly, but still tax revenues will come in the month of September. Tax revenue will again come at the end of the financial year, March. Now, how would government function without money? So, often what government does, it does various avenues it has. One of the avenues, it goes to the central bank and say, do I have any deposit like savings with you? Give that to me. Or if I don't have, can you give me a loan? There are various ways to get the loan. One is called the treasury bill route. It's like selling some bills like bonds, treasury bill, and getting the loan. So, here when you are talking about RBI credit to central and state governments, that means state governments can also do the same thing. Take a loan from the RBI, and RBI is acting like a banker to the government. Our banker is the commercial bank. Say the State Bank of India can be my bank when I take a loan. Oh, a loan means it will carry an interest, which government will have to pay. It is not an interest free loan. So, it is a proper loan, which in banking literature is known as credit, somebody gives the loan. So, net is what? Because this year this much government, both central and state governments together have borrowed from the RBI and also have returned some past loans. So, you will naturally get a net number, plus and minus which I have returned. So, the net outstanding loan is this. I have been borrowing last 5 years, which I have not returned, say 5 months, not 5 years, 5 months, 1 year, 1.5 year. Now, I am also returning part by part. So, at any point one needs to calculate what is the outstanding amount of loan, which will be a net amount. So, this is another source of monetary base. Why monetary base changes? Because when from RBI the money leaves, comes to government, and government starts spending on various things, the money is injected into the system. So, it is expanding the monetary base. Or when government issues more coins, it is affecting the monetary base. C is directly going to contribute into C. All right, this is a source from where money is getting affected, and if monetary base is affected, I will show that to you soon, then all monetary aggregates are affected. All right. Third point, RBI credit to the commercial sector. RBI credit to the commercial sector is very important. These are things which you do not know, but slowly when the course proceeds, it will become clear. Commercial bill वगैरह है, RBI credit can come to the commercial sector, which is a kind of puzzling a little bit, because usually banks give credit to the commercial sector, the businesses, commercial sector, the businesses. Why is RBI credit coming? So, I need to explain that. RBI credit to the commercial sector. Okay. Various ways RBI contributes to the commercial sector. Sometimes directly, sometimes indirectly. Let me give you an example. These non-banks which are part of the commercial sector, non-banking institutions, IDBI, SIDBI, state financial corporations, you know how they were founded? They were founded with, they are founded like a corporate company which has paid up capital or amount of shares. Paid up capital, you can open Google and find out paid up capital. It is like the amount of shares it can issue and get a money. Shares are what? Share is a source of revenue to a company. Now, this commercial sector financial institutions have often been founded by RBI and the central government like IDBI. So, इनका जो paid up capital है, it never went public. All right. In some ratios 70-30, 50-50, 40-60, the shares were bought by the RBI and central government. All right. So, here is a loan given to these IDBI etc., which were found when they were founded from the commercial sector. NABARD, which has become independent now, NABARD was a department of RBI. NABARD is National Bank for Agricultural and Rural Credit Development, Rural Development. NABARD used to be a department of RBI like Mechanical Engineering Department or Electrical Engineering Department, which was later became so big, it was asked to leave, like Mechanical Engineering Department asked to leave IIT Kanpur and become a separate institution. NABARD used to be a department of RBI once upon a time. If you go to Lucknow, if anybody is from Lucknow, it's a huge building of NABARD. You will see beside the Reserve Bank office, massive building. I saw that when I went for JE work there. We were on a ramp. You know, these ramps are there, flyovers, and suddenly I saw NABARD. I got, oh, I see. There is the regional office, zonal office. Massive building, just like RBI. Achha, so NABARD used to be a department. Now, these loans can come in the form of loans. Sometimes there is a financing facility provided. IDBI for some development or NABARD for some specific issue, RBI would give them a loan and often it would refinance it. When the loan has been returned to RBI, they go for a refinance, second term. All right, I give you 100 crores, you use that, after 2 years you return that money, again I give a refinance. This is how also RBI directly gets into financing business. Another way is that there is something called commercial bills, which commercial banks are not interested. Commercial bills are used for payments between companies. I cannot pay you now, I will pay you in future, commercial bill gets created. Now, the question is, okay, you cannot pay now, but who can pay me? I need the money, I have sold you something. Then the banks come and help them out. Often banks are not interested, or so that banks can get interested, RBI gives some cash to banks to deal in commercial bills. The commercial bill market in India is very poor. I will talk about that later. Business house people, if they are here, their parents would know about commercial bills. Father, I mean, parents means father. If any business community person is here, I will talk about commercial bill later. So, there is various kinds of things that goes on where RBI directly or indirectly starts giving loan. And as soon as money leaves RBI, RBI is like moon, something leaves moon towards earth is an addition to earth. The economy does not consider RBI part of it or government, they are considered to be outside satellites. So, anything comes from there to earth then becomes part of earth or affects the earth. That is the economy, that is how we think. Government, central bank, they are all outside agencies. So, this is what affects monetary base. 4, I have written it here separately because that used to be a huge issue for rural development. Now, I have the data I will show you, I will put them together. That used to be in books, traditional books, it used to be separate. This is RBI credit to NABARD. Five. Achha. Net foreign exchange assets of the RBI. This is most important. Now, in the modern context, net, this you understand what I am saying. How would NABARD function? NABARD takes loan, gives the loan to banks, gives the loan to farmers, sometimes directly for rural development. That is all. Now, it is doing so well, it does not borrow. Last 7-8 years, I have seen data, it does not borrow a single pie from RBI or has debt. NABARD is amazing. Some institutions in this country which is otherwise functioning very poorly is functioning so well, like people talk about IIT is functioning very well compared to general education institutions in India, colleges and universities not functioning well. It's just like that. NABARD is functioning so well, last 7 years, 5 years data I have seen has not taken, does not have a single paisa debt to RBI. I will show you the data later. Next comes net foreign exchange assets. Of the RBI. Net foreign exchange assets of the RBI. This is very important. And when I will show you the numbers, that will fascinate you. Why monetary base is changing in India? What is changing? Net foreign exchange assets is very simple. You are an exporter. So go out and sell something abroad. Come back home with dollar. You can keep dollar at home to show people that you have earned dollar. Otherwise, dollar has no usefulness. Then you go to a foreign exchange dealer, get it converted into rupee, that what fattens your bank account. So foreign exchange किधर जाते हैं? जमा हो जाते हैं the dealers and RBI, the central bank. So every time RBI receives foreign exchange, that means it has been converted into fresh money into the economy. You came back home with dollar. Then when you exchange, what is happening? The dollar gets deposited in with RBI or the dealers, and in return you get the rupee, which goes into your accounts and you start spending it. So money gets, fresh money gets part of the country, monetary base, out of which deposit reserves go to RBI, some currency goes to people who start spending them, etc. C and R getting affected. Source of C and R. All right, very important. Why net? Because there is a drain of foreign exchange also. No? When you are buying things, what happens? You take your fat account money to RBI or a dealer and tell him, please sell me dollar. So the rupee goes to now reverse process. Rupee goes to RBI and dollar comes to him, which then leaves the country for import purposes, goes to Saudi Arabia, from whom we have bought oil, goes to Germany, from whom you have bought manufactured goods, goes to Brazil, from whom you may have bought sugar, goes to Russia, from where you may have bought wheat. All right. So net, the word net is there. Now, monetary base up to this point is real fun. Monetary base, simple 5 items. So M naught from the source point of view is simply 1 plus 2 plus 3 plus 4 plus 5. ठीक है? All right. 4 plus 5. लेकिन एक माइनस नंबर है इसके बाद. ये बहुत ही गड़बड़ी है. सब ऐड करने के बाद you subtract NML. Now what is NML? NML is net monetary liabilities of the RBI. Net non-monetary liabilities of the RBI. What does it mean? Any time a currency goes into the economy, it's the liability of the RBI and the government, whoever issues that. If it is coin, it's the liability of the government. If it is rupee, it is the liability of central bank because the governor signs on it. You take a note out, you will see that. Liability means he is responsible for that note. If it is a true note, nobody can turn it down during a transaction, refuse it. He is responsible or the institution is responsible. Net non-monetary liabilities, which has a connection with money, but this is not fresh currency that RBI has pumped into the economy for some reason. The net non-monetary liability arises from various things. Suppose I'm trying to explain this. This is not very clear in the books because RBI side doesn't carry definitions so well. They carry data. It's like a data bank. variable x, variable y. Now, I am looking for a definition. Now, what I found is, suppose RBI has this amount of dollar. Now, Indian currency is depreciating with respect to dollar. So, every dollar costs more rupee. Now, that dollar value, when it was exchanged against rupee in the past, had an exchange rate. If the exchange rate has deteriorated, which means more rupee, that deterioration means more rupee per dollar, 55, 56 rupee as opposed to 47 rupee 2 years back what it was, or 1 year back, then if you calculate the current market price value of that foreign exchange, it will show more rupee. India में RBI दिए है equivalent, but that is not the case. When it was exchanged, it was a better exchange rate. Now, the exchange rate has depreciated. So, the assets got revalued at a higher price, it is showing. That you need to deduct the difference, because otherwise the balance sheet will not match. Actual currency pumped in is this, equivalent amount dollar etc. sources will show a larger amount at current prices of gold, foreign exchange, all these valuable things. They all are included in net foreign exchange, I think. All right. So, net non-monetary liability is that, do not think so much liability RBI has increased just because gold prices have gone up. तुरंत वो जो खरीदा था मेरे पास से सेल किया था गोल्ड, उनको बुला के भाई भाई और ज़्यादा रुपये आपको मिलेगा आज क्योंकि भाव बढ़ गया, ये नहीं होता है. Do you understand what I am saying? भाव और बढ़ेगा नहीं, भाव मेरे तरफ हिसाब के लिए बढ़ गया तो उसको कटो, डिडक्ट करो, to balance the balance sheet. Otherwise, the currency, Indian currency, that what it shows, and the sources that you are listing on one side won't balance, because the dollar is showing, अरे you must have pumped more currency. अरे आज का डॉलर का रेट ना, वो आज का गोल्ड का रेट, जब पंप किया था तो और कुछ रेट था, तो उसको एडजस्ट करना पड़ता है. This is what I have understood. Net non-monetary liabilities is because of fluctuation in international price of exchange rate, gold, etc., which are part of the foreign exchange assets or assets of the RBI, which gets converted into rupee, etc. Do you understand what I am saying? So, that item is deducted. So, the M naught value that you will get is, if it will be exactly matching with the individual 5 numbers added up minus what RBI is saying is the net non-monetary liability, will match M naught year to year. Okay? If you go directly measuring M naught through uses, which is currency with the public plus cash with banks plus bankers deposits with RBI plus other deposits, they will match. If you go adding these up and subtracting, there may be a statistical 0.003% error somewhere, but they should exactly match the numbers. Achha, now I take your question.
So if the currency appreciates rather than depreciating, will NML be an evident number?
Yeah, exactly. Very good. So, be careful. Minus and minus, which I teach my child, my son, minus outside bracket and within bracket -4, he is getting totally confused. And you can imagine trying to teach this. I mean, for you, for adults, is nothing who has been seeing it for 20 years. For a child, I am trying to teach minus bracket minus, अरे बाप रे बाप, वो माइनस ही तो काफी था उनके लिए, उसके बाद और एक माइनस लगाया है. What you are saying is exactly true. That's what you have to be careful. Yes. So, I am teaching you something very important. I am going into the deeper things of macroeconomics, in fact, to some extent. Why does money supply change? Because monetary base changes. Why does monetary base change? Because of these reasons. and therefore money supply changes, and then you have the macroeconomics which is already taught to you. Get into more and more complex models, static, dynamic, whatever. Since 2006-07, NABARD credit has become zero. All money returned. 2006-07. 2006-07 is roughly 5 years. God, yeah.
So this RBI trade to the central and state government, do we take this as public debt or?
That is part of public debt, internal debt. Very good. Public means government. Public की ये ना सोचो economics में public जो say for instance बाबा रामदेव का लीला चल रहा है दिल्ली में पब्लिक, उधर में बहुत पब्लिक है, मैं देखा सुबह में, वो पब्लिक नहीं है. इकोनॉमिक्स में पब्लिक, इकोनॉमिक्स public servant means government. I am a public servant. I work for IIT, which is a government organization. Public Service Commission, Union Public Service Commission, UPSC, UPCS, Public Service, UPSC. If you go for IS jobs, you will have your examinations conducted, interviews held by Union Public Service Commission. Public means government. Next is credit multiplier. Let me talk about now slowly the connection between money supply and monetary base. I will slowly get into that. I will start with a very simple multiplier concept in monetary economics, not macroeconomics, monetary economics, multiplier. Let me explain that to you. Credit multiplier. Credit multiplier. When banks give a loan to somebody, it creates a multiplied effect on the economy, which we usually don't understand. And I need to explain that to you. Multiplier, Keynesian multipliers, expenditure, government spends 100 crores, the total impact on the economy in a simple model without taxes or simple proportional tax 1 over 1 minus c into 1 minus t, which is not a fraction, which is a number greater than 1. So, the final impact on the economy is fourfold, 4.5-fold. So, it becomes 400 crores worth of income generated. This was the insight that came from Keynes in macroeconomics, whose parents or fathers or teachers did not have that classical model made. Now, credit multiplier is a fascinating stuff. Now, I am getting into a connection between monetary base and money supply with a very simple thing called credit multiplier. Now, you will understand, and what you will see is that the money supply that you hear in macroeconomics is actually a multiplied effect of the monetary base. That is why RBI is aisa khada rehte hai, as if on a giant screen it is watching what is happening to M naught. Because any change in M naught creates not a ripple, it creates a large tsunami type wave maybe on M naught or on monetary aggregates, money supply what we call M1, M2, M3, M4. That is why they are so conscious about it. Now, I start that discussion, the connection through credit multiplier. When bank gives out loan, it creates a multiplied effect, and I will use Mishkin to develop this example. Mishkin begins this explanation of credit multiplier by mentioning open market operation. And let me explain that, because you would open Mishkin and you would like to know what would happen, what is open market operation, which is called OMO. Mishkin opens this, starts this discussion with open market operation. This is a standard method that open market operation, you may have heard in macroeconomics, that central banks of countries use to control money supply, either increase or decrease. What is that? Central government and central bank often participate in selling of bills, government bills, which are bonds, etc., treasury bills, whatever. When bills they sell, money flows into RBI, so the money supply in the economy falls. When they repurchase the bills, they give cash back to the public, not public here, government, to the people, the economy, and the money supply increases in the economy. This act of buying and selling of bills, buying of bills would increase money supply, selling of bills would decrease money supply, is called open market operation. Standard method. It's a formal name, open market operations. Suppose government conducts an open market operation which is purchasing a bill from a bank. Banks often buy government bills. That's banks think that is a form of investment, in fact. Okay. Suppose government conducts an open market operation which is open market purchase of some security sent with a commercial bank, call that the purchase of security, purchases security from a bank. Security is bill worth, this is Mishkin, 1000 from a bank, from bank say A, purchases security from bank A. This is a cash of 1000. What happens to the bank? Bank suddenly receives 1000 rupees. Now, what does bank do with 1000 rupees? Bank, the cash reserves will immediately increase by 1000 rupees of banks. What will this do? R will increase by rupees 1000. Cash reserves of banks will increase by 1000. Source affected. So, monetary base has increased by 1000 rupees. Ceteris paribus, keeping other things constant, implying M naught has increased by rupees 1000. Ceteris paribus, keeping other things constant. Now, the bank becomes greedy. 1000 rupiya kya karu? Give it as a loan. So, it gives it out as a loan to a firm and it leaves the bank, bank A, and the firm which receives the loan, simple example I am giving you, goes to bank B and deposits that money. Okay? Now, loan worth rupees 1000 given to a firm, deposits it in bank B. बैंक बी में उनका सेविंग्स अकाउंट है, उधर रुपया डिपॉजिट किया, इधर से लोन लेकर, and it will use. What does bank B do? Bank B sees that loan. Bank B deducts, since it is a loan, it has come through a savings account, CRR at the rate 10%. So, it deducts how much? Rupees 100, and 900 is still there, all right. And this is what bank business is. I am simplifying it. It will again deduct a cash which the person can withdraw from a loan, all right, and then whatever remains, it starts gambling with it. I am eliminating that cash that bank will keep on a simple 1000 loan. So, bank B gives rupees 900 as loan to another firm. $1,000 of the total deposit is hardly anything, so it gives out 900 part of a loan to some other firm. That firm takes 900, deposits in his bank, whatever bank it has, it gets it through NABARD or whatever, somewhere it deposits, some bank, where bank sees a deposit has increased by 900, deducts again 10%, which is CRR applicable to all banks, same CRR, because it's a central bank regulation. It is not your bank pays this CRR and his bank pays another CRR, a CRR. So, out of 900, 10%, 90 rupees is deposited, 810 remains, which then bank sees is a cash available and gives out as a short term loan maybe to somebody. So, the money which leaves the first bank 1000 rupees gets smaller and smaller because of deduction of CRR, but goes through the economy via the financial system into the public. So, what basically happens, this is the last line and you can go home, the total increase in deposits, delta D, where D is the total deposits in banks, the total increase in deposits will be the change in reserves that have taken place. In the first round, change in reserves is 1000. In the second round, the change in reserves that takes place because of bank deposits is delta R into 1 minus R, where R is CRR, cash reserve ratio, plus delta R into 1 minus R of that, is an infinite series. Reserves changed by 1000 rupees when central bank conducts an open market purchase. I give that as a loan, entire amount delta R, which is 1000. Second bank, when it goes, it doesn't give out loan as 1000, it deducts the CRR and gives that out as a loan to somebody else. The third person, second person deposits in a second bank, from where it goes out to a third person and gives out 1 minus R of that is taken out as a loan. It becomes a geometric series, which when you add, what will you get? Delta D is equal to 1 over R into delta R. This 1 over R is a simple credit multiplier. If you know CRR value, it's very simple to calculate the credit multiplier. CRR is 7%, so 0.7, 7% is 0.7, no, 0.07. So 1 over 0.07 is the credit multiplier. In a simple world, the world is not that simple, I will explain that, it's much more complex. But in a simple world where there are no excess cash reserves held, otherwise more amounts will be deducted, just not R, 1 minus R minus something will also be deducted, and then that loan will be given out. When a bank receives some money through a deposit account, CRR is deducted, but something more is also deducted. Bank keeps the money for your withdrawal purposes. They know your habits, average habits of individuals in Kanpur, how much money they withdraw per month from the accounts. So they do a whole lot of average calculations, and then the balance amount they give out calculated basis as loan.